Airbnb delivered a clean beat for Q2 2026. They completely snapped that brutal three-quarter streak of earnings misses. Revenue came in at $3.61 billion.
Yeah, which is up 16.5% year over year. It easily beat the $3.58 billion estimate.
Exactly. And EPS hit $1.37. That cleared the $1.25, $1.26 consensus without a problem.
And they didn't stop there. Q3 revenue is now guided to $4.69 billion to $4.77 billion.
Right, which implies 15 to 17% year-over-year growth. Plus, they raised their full-year 2026 revenue guidance to at least mid-teens percentage growth.
And they bumped the full-year adjusted EBITDA margin target to at least 35.5%.
The market reaction was it was explosive. The stock jumped over 17% the following day.
Yeah, breaking out to a four-year high of $178.07.
Yeah.
Options markets were aggressively pricing in continued upside.
It's a huge shift. When a company misses consensus 3 times in a row, Wall Street usually starts writing the obituary.
Right. People just assume the growth story is fractured. But these numbers, they force complete rewrite of that narrative.
Which is exactly what we are going to do today for you. We've pulled together Airbnb's Q2 shareholder letter, the live earnings call transcript, and a fresh batch of analyst notes.
To figure out if this explosive quarter is just a lucky one-off anomaly or if it's the start of a real structural turnaround.
Right. And to answer that, we have to look past the headline beat. We need to dig into the actual mechanics of the business right now.
And you always start that by looking at the leading indicators. Top-line revenue is great, but it's a lagging metric.
You want to look at gross booking value, GBV.
Exactly. That metric hit $27.2 billion for the quarter, up 16% year over year.
Wow. And the actual underlying volume, the nights and seats booked, that accelerated from Q1, right?
Yeah, growing 10% to hit 148.3 million.
Okay, let's unpack this because volume is up, but pricing is actually holding incredibly strong too. Average daily rate, the ADR, rose 5% to $184.
Even if you strip out the foreign exchange impacts, you are still looking at a very solid 4% growth there.
But what really jumped out at me from the analyst notes is just how broad the regional strength was. Like, North America saw high single-digit growth.
Which might not sound like a face-melting number, but...
Well, that's their best growth rate in that region in almost 3 years.
Right. It's a clear sign of maturity in their most saturated market.
Right.
But the emerging markets are where the growth is, frankly, staggering.
Yeah, Latin America grew roughly 20%. Brazil origin nights were up over 30%.
And Asia Pacific was up in the high teens. The real standout there was India. Origin nights accelerated by a massive 60%.
So what is driving that hyper-growth in places like India and Brazil? I'm guessing this isn't just organic word of mouth anymore.
No, definitely not.
Are we seeing the result of localized marketing? Or is this just a macro story about a rising global middle class finally getting access to mobile booking?
It's really a combination of both. The earnings transcript notes that they've been heavily investing in localized brand campaigns in those specific regions.
Tailoring the product to local payment methods, right?
Yeah, and to cultural travel habits. But you're right to point out the macro trend. You have an expanding middle class in India with increasing disposable income.
Combined with an aggressive push by the platform to onboard local supply.
Exactly. When you match localized supply with newly minted, highly mobile domestic travelers, you get a 60% acceleration.
That makes total sense. But let's bring it back to that average daily rate of $184, because the sources point out something really interesting about the composition of that ADR growth.
Right, it's not just inflation.
Yeah, they aren't just slapping a 5% blanket price hike across every studio apartment in the world. It's more like, it's like upselling the whole menu.
How do you mean?
Like, the platform isn't just raising the price of the basic burger. You, the consumer, are actively deciding to order the steak.
Right. The data shows a very specific structural mix shift in what people are actually booking.
Exactly. The shareholder letter highlights a mix shift toward entire homes with 4 or more bedrooms.
Yeah.
To me, that screams that we are seeing a structural shift toward group and family travel rather than, the solo business traveler just renting a room for the night.
What's fascinating here is how well that aligns with broader post-pandemic macro trends.
Remote and hybrid work flexibility, right?
Yes, it has fundamentally changed the travel landscape. It enables multi-generational family vacations or large groups of friends to travel together.
They can work from a laptop on a Thursday and split the cost of a massive house over a long weekend.
And that dynamic naturally drives up the average daily rate for the platform. They're capturing high-value group travel.
Which is significantly outpacing the growth in private rooms or shorter solo stays. But I mean, top-line growth and high ADRs don't mean much to a retail investor if the company is just setting cash on fire to acquire those bookings.
Very true.
Let's look at whether they are actually retaining this revenue as profit. How is the operational leverage looking?
The profitability metrics are incredibly strong. Adjusted EBITDA hit $1.3 billion for the quarter.
Wow.
Yeah, that expands their EBITDA margin to 35%, up from 34% a year ago.
And they also generated a very healthy $1.3 billion in free cash flow in Q2 alone. And looking at the capital allocation, they aren't just sitting on that cash.
Not at all. They aggressively return capital to shareholders, repurchasing 7.9 million shares for $1.1 billion in the quarter.
Net income came in at $816 million, representing a 23% margin. Though, I mean, to be fair to the math, the analyst notes do point out that the bottom line was aided by a $77 million tax benefit.
Related to prior year taxes, yeah, that's true. But even if you back out that tax benefit, the core operational leverage is what you really want to pay attention to here.
Right.
A massive standout in this earnings report, and something Wall Street is absolutely loving, is their AI-driven efficiency.
Yeah, this was crazy to read.
Their customer support cost per booking plummeted by roughly 16% year over year.
Wait, 16%? For a company processing nearly 150 million bookings a quarter, that is just an ocean of saved cash. How exactly are they pulling that off?
Because their AI assistant is now resolving nearly 45% of customer support issues without ever touching a human agent.
That is a staggering containment rate.
Especially for automated support in a service-heavy industry like hospitality.
See, I have to push back on this AI efficiency narrative, though.
Okay.
Sure, the margins look fantastic today, and analysts always applaud cost-cutting. But think about this from the user's perspective.
Right.
If you're booking a luxury 4-bedroom house for your family vacation at hundreds of dollars a night and something goes catastrophically wrong,
The host gives you the wrong code.
or the AC is broken in the middle of summer, do you really want to argue with a chatbot? If you automate 45% of customer service, aren't you risking alienating premium users?
The ones who expect a human touch when a high-stakes booking goes sideways. It raises an important question about the tension between short-term margin expansion and long-term brand equity.
Exactly.
The bull case from management is that the AI is only handling the low-hanging fruit. We're talking about routine cancellations, simple refund policy questions, basic reservation modifications.
This is easy stuff.
Right. By filtering out 45% of that transactional noise, human agents theoretically have significantly more bandwidth. They can instantly handle the high-stakes, complex issues you just mentioned.
With more empathy and less hold time.
Exactly.
But the bear case, and honestly what I would be terrified of as an investor, is that the AI containment net inevitably catches people who actually need nuanced help.
Leading to a doom loop of automated responses.
And massive frustration. If you burn a high-value customer with a bad support experience and they churn out going back to booking traditional hotels with front desks, those customer service savings get completely wiped out.
By the lost lifetime value of that user. It is a very delicate tightrope to walk. But for this specific quarter, the market is aggressively rewarding the immediate margin expansion that this AI leverage provided.
Okay, so the margins are highly optimized and cash flow is robust. Now we have to look forward. What exactly is management doing to ensure this mid-teens growth actually continues into 2027?
Well, a huge part of the strategy relies on mobile app adoption. Nights booked on the Airbnb app increased 23% year over year.
Wow.
And app bookings now account for 64% of their total nights booked. That's a massive, intentional shift away from web browsers.
I saw that highlighted across multiple analyst notes. My guess is that app users are just inherently stickier.
Absolutely.
Once you have the app taking up real estate on someone's home screen and you have push notifications enabled, your customer acquisition cost, your CACs, it has to drop through the floor for future bookings.
You aren't paying Google for expensive search clicks every single time that user decides they want to take a vacation.
Exactly. You own the distribution channel.
And it's working to bring in fresh blood, too. First-time bookers grew 11%, which management noted is their highest rate of new customer acquisition in 4 years.
Here's where it gets really interesting, though. Where are those new users actually coming from?
This was a surprise.
The sources highlight what I can only describe as a Trojan horse hotel strategy. Boutique and independent hotel nights booked on Airbnb grew 3 times faster than their core homes business.
3 times faster.
And crucially, 35% of those first-time hotel guests returned to Airbnb later to book a traditional homestay.
It is a brilliant, almost subversive customer acquisition funnel. You attract a traveler who prefers the predictability, the front desk, and the standard amenities of a hotel.
They come to the platform specifically for that.
Right. But once they book, they download the app, they get comfortable with the user interface, their credit card information is securely saved.
So the next time they travel, maybe this time with a larger group of friends instead of solo, the friction to book an entire home on Airbnb is completely gone.
They've already crossed the trust barrier.
And once they have you in that ecosystem, they are pulling several new monetization levers, just squeezing more value out of every single transaction.
Like the travel insurance.
Yeah, the shareholder letter points out that guest travel insurance revenue jumped over 60% year over year.
And they are pushing a reserve now, pay later feature that is successfully driving guests to book their trips much further in advance, which locks in that revenue backlog.
Plus, they're rolling out all these new Airbnb services like grocery delivery, car rentals, and luggage storage. So, okay, let's unpack this. What does this all mean?
It's a big pivot.
With the rapid growth of hotel bookings and all these add-on services, is Airbnb quietly abandoning its quirky home-sharing roots? Are they just becoming a traditional online travel agency, an OTA, just like Booking.com or Expedia?
What you're observing is how they are aggressively redefining their total addressable market. They are absolutely transitioning from a pure-play alternative accommodation platform into a comprehensive travel super app.
The super app.
Yeah. By integrating hotels, insurance, and on-the-ground logistics, they're trying to maximize their share of wallet for every single trip.
They don't just want to monetize the bed you sleep in anymore.
No, they want to take a cut of the rental car you drive from the airport, the experiences you book, and the groceries waiting for you in the fridge when you arrive.
Which, I mean, that makes complete financial sense. If you already have the eyeballs, the saved credit card, and the user's trust, why let that revenue leak to third-party rental car companies or grocery apps? Keep it all in-house.
Precisely.
Yeah.
But it fundamentally changes the identity of the company. From a scrappy disruptor of the hospitality industry into a major, highly diversified incumbent within it.
Right.
And with that scale comes a whole new set of operational challenges.
Which brings us to the reality check portion of this deep dive, because it's easy to look at a quarter where everything goes right and just extrapolate that into infinity.
But you have to look at the risks.
Responsible financial analysis requires looking at the actual foundation. Let's look at the specific risks and macro headwinds that management and the analysts are flagging right now.
Geopolitical and macro anomalies are at the very top of that list. For instance, the ongoing conflict in the Middle East served as an estimated 100 basis point headwind to Q2 nights booked.
Wow, 100 basis points.
Yeah, it led to a very real increase in cancellations across the broader EMEA region, Europe, Middle East, and Africa, though the region is starting to show some signs of stabilization and recovery.
But on the flip side of anomalies, you have the 2026 FIFA World Cup, which provided this massive, unrepeatable tailwind for the quarter.
Huge tailwind.
The tournament brought in 150,000 new listings from first-time hosts across North America alone, just to handle the flood of soccer fans.
Right.
So I have to pose a direct, critical question here to you. Is that raised Q3 guidance setting them up for a massive failure?
Yeah, it's the big debate right now.
If the Q2 numbers were heavily propped up by a massive one-off event like the World Cup, bringing in a tsunami of volume, how realistic is it to maintain mid-teens revenue growth when all those fans pack up and fly home?
It is the classic post-event hangover risk, and it's the #1 thing analysts are watching. Management's bet is heavily placed on the sticky nature of those newly acquired users and hosts.
So they think they'll just stay on the platform.
The assumption baked into that raised Q3 guidance is that a significant portion of those 150,000 new hosts will realize the economic benefit of renting their homes and just decide to keep their properties listed.
Right.
Concurrently, they are betting that the first-time bookers who only downloaded the app for the matches will return for their regular family vacations next year.
But if they don't, meeting that $4.69 to $4.77 billion Q3 target will require their existing core user base to significantly increase their booking frequency, just to fill the gap left by the World Cup.
And that is a tall order in any macroeconomic environment.
It absolutely is. And beyond the macro events, there's mounting friction on the supply side, the hosts themselves.
This is a huge structural issue.
The earnings call touched on the fact that Airbnb is currently migrating most of its property management software hosts to a single 15.5% service fee. This is a massive structural change that has left many professional hosts feeling very uneasy.
Yeah, and let's break down why a fee structure causes so much friction. Historically, Airbnb offered a split fee model.
The host paid a smaller percentage, say 3%, and the guest paid a highly visible service fee of around 14% at checkout.
Right, but by forcing a single 15.5% fee onto the host, it mimics the traditional OTA model used by competitors.
The host now has to absorb that entire 15.5% fee or bake it into their nightly base rate.
Exactly. So while it makes the pricing look simpler for you, the guest, because there are no surprise fees at checkout, it shifts the optical burden entirely onto the host.
It makes the host's base rate look artificially higher when guests are comparing prices across different platforms. If a host lists on Airbnb and Vrbo, their Airbnb nightly rate suddenly looks much more expensive upfront.
Even if the total price paid by the guest at the very end of checkout is identical.
And when you add that friction to the general regulatory risks regarding short-term rentals that continue to lurk in the background of almost every major tourist city.
Think about the crackdowns in places like New York or Barcelona.
Exactly. You can see why supply-side retention is just as critical, if not more critical, than demand generation.
It all comes back to managing a highly complex ecosystem. Airbnb proved in Q2 that it can drive incredible demand, expand margins with AI, and cross-sell new travel services.
But none of that multi-billion-dollar ecosystem functions if the hosts providing the actual physical inventory decide the platform is too expensive, too optically penalizing, or too restrictive to use. Which brings us right back to our original mission for this deep dive. The financial X-ray looked muddy for 3 quarters, but Q2 proved the underlying business engine is incredibly powerful, highly profitable, and expanding its reach.
The numbers don't lie.
But I want to leave you with a final provocative thought to mull over regarding this ongoing hotelification of Airbnb.
Okay.
If the platform successfully integrates independent hotels, car rentals, and grocery deliveries, they essentially own the entire travel wallet. They become the ultimate frictionless travel super app.
Right.
But if they enforce strict, standardized 15.5% fees on individual hosts to fund this OTA empire and rely on AI chatbots to handle the customer service, do they risk losing the unique, quirky supply and personal connection that made them famous in the first place?
That's the real risk.
If every Airbnb starts to look, feel, and price exactly like a professionally managed, standardized hotel room, why wouldn't travelers eventually just go back to booking a hotel?
It's the ultimate tension for any mature disruptor. How do you scale aggressively to satisfy Wall Street's growth demands while preserving the unique soul of the brand that created the market in the first place?
That is the multi-billion-dollar question we will be keeping a close eye on as we move into the back half of the year. Make sure you follow the show for daily, no-nonsense earnings coverage to stay ahead of the markets. Catch you next time.